Okay. We're a million people right now.
Okay. We're ready to go?
Yes.
Okay. Hi, everyone. Thank you for joining us. It's Larry McDonald with the Bear Traps Report. Nancy Davis, our longtime advisor, is here, mentor, big helpful to our book, How to Listen When Markets Speak. And Nancy's been in our Bloomberg chat for at least 5 to 7 years now, going back. And you're helping us with the yield curve, rates. There's a lot going on. There's a lot of mixed messages, especially today. CPI really backward looking, considering the fact that you've just had this big move in the Straits of Hormuz again with less traffic coming through. 120 days shut. 120 days shut. That's the CPI number is literally just backward looking at this point because you've got the summer driving season, you've got the Straits really shut down, and there's a lot of questions from clients because we've had this like the 2022 experience, Nancy, where we had the inflation shock because of the war in the Ukraine, and but interest on the debt was 250 billion. Now it's 1.1 trillion, right? So the ability of the Fed to hike is in a different world. Plus, the bottom 65% of consumers have had inflation destroying them for 4 years, right? It's people don't understand. It's not about where inflation is like month over month. It's the cumulative effect on human beings. Yeah. That affects moods and politics, and it's going to have a big impact on the midterms. Your experience at Goldman Sachs, you have an incredible career. IVOL is probably literally in the history of, I think, ETFs, the most influential in fixed income, probably first mover advantage, the IVOL ETF. Now, walk us through IVOL. What type of investor buys IVOL? You're looking for bond volatility or a steepening yield curve, and how does that apply to today?
Yeah, both of those we went with IVOL. IVOL is essentially a way of accessing inflation outside of just the consumer price index. So TIPS are, pretty new. They only started, the US Treasury started issuing them in 1990.
Treasury, that's inflation protection.
Yeah, Treasury Inflation-Protected Securities, which are a type of treasury bond, but it resets with only CPI. The ag index, which is what is considered core fixed income, has no inflation protection in it at all. There are no tips. And then
think of the trillions of dollars that are tied to the ag.
I know.
And there's no inflation protection.
And the other crazy thing is 35% of the ag is actually short OTC interest rate options from the prepayment risk. Like prepayment risk is just a nice, I call it like a G-rated way to say short an OTC option, right? Because somebody else is long. In the case of mortgages, homeowners are long. In the case of callable bonds, corporates are all long. But 35% of the ag is short OTC options. And IVOL is a really nice complement to add tips because we have, tips as our base, and then we do an overlay with options on the yield curve, which solves, another index outside of CPI. And it's a really interesting time because right now the market has priced in hikes from the Fed, the term structure of interest rates. So the yield curve is incredibly flat. It's steepened a little bit.
And that's important that what we track, the Bear Traps Report, is capitulation. And you can see it in the chat when you make the conversations, when you do the dinners, when you run the chat, you do the meetings. The amount of funds that have been really carted out on the steepener, I think I'm smelling a big capitulation the last 3-4 months. I think we're getting close to the end of that. But explain, like, the steepener was a really crowded trade, and now we've flattened because obviously at the long end, people are worried about, okay, well, first of all, how many hikes are they actually going to be able to do on the short end, right?
Yeah. Yeah, so totally. It's the yield curve has fallen this year almost 90%. We had 3 years of curve inversion, so 22, 23, 24, 25 it uninverted. It went to 49 basis points at the end of 25. Now the 2s10 SOFR curve is back at 10 basis points. So Japan, to compare, their 2s10s curve is closer to 125 basis points. So ours is 10 right now.
Right.
And to me, that's just a really nice hedge for both equities selling off, credit spreads widening, as well as bonds. And we see that addition as like just another index to capture inflation outside of CPI, which, we've been talking about for years. IVOL is not a new fund. It listed in 2019. So it's been around for, 7+ years. But I think now it's more common knowledge that, people know that CPI is just one index. It's an index that is by definition a third of its rent. It's calculated by survey data. It's just not the only index to think about inflation. And I think to your point, like to me, inflation is not a trade. Like, I think a lot of people have been carried out by trying to have inflation expectations, trying to have steepeners, and doing it in one delta format's really dangerous because there's no zero bound.
Right.
And think about, like, the asset went from, 49 basis points to 10 in just like this first half of the year. So that you can lose a lot of money.
So let's let's really focus on the big picture. So the Lacey Hunts of the world, the Rosenbergs of the world, these are the bond, well-respected bond people, have been preaching rate cuts, recession, right, for a long time. And they're in a lot of pain because we're in this world of multipolar world. At the front end, we get sticky inflation. And you just, the ability of the Fed to really cut with so much fiscal spending, 1.8, 1.9 trillion, literally 17 trillion of fiscal and monetary response since COVID, 17 trillion. So you've had two presidents that are really trying to prevent the business cycle from functioning, and all of that fiscal and monetary has prevented recessions. Now, what would make the yield curve steepen, in my view, is, and this is what we've been talking about, the bank earnings today. Some of the most impressive people in our chat that have made a lot of money on subprime, the credit weakness in the data centers potential and the credit overbuild. This is the type of thing that would create a credit event that would actually bring on recession risk. And in that case, you would have a vicious steepening, right? And it's I'm telling you, it's out there in the next 6-9 months, maybe 3 months. I think there's a credit event coming. This bank earnings today was epic good, right? And we've been saying that, but this is the sell the news event. Let's go through the slides, but the consumer's in a lot of pain. There's a lot of credit risk that's building. It feels a lot like 2007. And if there's any surprise on the credit risk side, which I think is coming, and some of the most impressive investors in the chat that were bullish to the financials, really bullish, massively have now gone bearish to the financials because of this, a whole bunch of different pieces of credit risk. We can go and talk about private credit, we can talk about data centers. There's we talk about the consumer, like there's 5 or 6 balls of potential credit risk coming at us. But those are the types of things that would give us a steeper yield curve. So IVOL is an example, but my point is, okay, what is the big picture? The big picture is some type of an event forcing us from a flat curve to a steep curve, like a 2007, 2008 event. Let's go to the slides and say. Okay, so here you have the Straits of Hormuz. Okay, this is 120 days. So this gets back to interest rate risk, sticky inflation. This is the amount of ships that are going through the Strait of Hormuz. So this is the type of risk that would impact the credit markets because of sticky inflation, higher bond yields on the long end. This is going to play out in CPI as well, and now that's toward the flattener. So if this continues for now, we're 120 days of this shut. The second, third order effect, we saw it this weekend with the diesel. We can go through gasoline. So the Trump administration has brought down oil prices, but all the distillates are still way up there. That's going to play into CPI. Unfortunately, if you have a steepener on, that hurts you, because if CPI stays sticky, the market perception is that the Fed has to hike. But the Fed can't hike because the bottom 60% of consumers are in so much pain, and interest on the debt's 1.1 trillion. They like once or twice. But this is an example right here of this chart where Trump is trying to get out. He kicked the hornet's nest. I think the rhinos and a lot of people tricked him into this. They thought it was going to be, it's a little Venezuela situation. We'll be in and we'll be out. He's dealing with 5 factions in Iran. He can't get out of this. He clearly tried to do the memorandum of understanding, but he did it with like one or two factions, and the other factions. And on the Israeli side, same thing. You got people in Israel on the hard right that don't want this deal, right? They don't want the memorandum every day. This chart stays this way. It's a problem for inflation, and it's a problem for the long end of the yield curve. Next one, Jose. Now, that is okay. So this is an example. I can't read that one. Let me see here. Oh, that's okay. That's the staples versus the S&P. Okay, so once again, this is an inflection point, quarter end, month end. Look at the staples. So this is the staples underperforming the S&P 500. So as the economy has they're running it hot, and as inflation's been sticky, it's hurting margins. Like look at Pepsi, look at Caterpillar. Look at Costco last week. You've got margin pressure. So the staples, we think there's a turn here because once again, if you have that recession risk rise in the next 6 months, the staples are going to dramatically outperform the S&P. This is a high capitulation. We're getting almost a category 5 underperformance of the staples versus the S&P 500. And on the bottom right there, we're getting a sharp signal and divergence. Next one, Jose. And then here's consumer discretionary. This is fascinating. So as bad as the staples are underperforming, the consumer discretionary names are doing worse. So that's your Home Depots, any company that's exposed to inflation, exposed to the consumer. So as you can see there, the consumer discretionary names are underperforming and falling down against the staples. This is the same type of thing we saw before all the big credit events in recent years, in the last 20, 30 years. When the consumer discretionary names start underperforming like that, that means the consumer's wounded. It also prevents hiking from the Fed, right?
And I think vol too, like that's one thing like we, to talk about, like going back to IVOL. IVOL is long interest rate volatility.
Right.
Like it owns options, so it's always long vol. And I think when you're looking at hedges, like yes, you could try to diversify in sectors, but you still have equity risk. And I think adding, if you do nothing to your bond portfolio, 35% of it is short OTC options embedded in CUSIPs.
Well, explain that to them. If 35% of
the ag. Yeah.
So that's your corporate bonds. So if you're long a lot of bonds, if you're long an index of bonds.
Yeah, if you're, we have a slide on that if you want to.
Okay, we'll get there.
Yeah, but it's
next one, I think. Okay, so this is one thing that's preventing the curve from steepening, right? So you've got this sticky. You got the summer driving season, the World Cup in all these different parts of North America and Central Mexico and Canada and the United States. The difference, the spread between, and that's why crack spreads are so wide. So the Trump administration is pushing down oil, but they can't control all the distillates, and so this points to an inflation shock, but it also points to potentially more pain for the consumer, which would create recession risk. Next one, Jose. And the same thing here. This is CPI year over year versus versus BCOM. So the red is the Bloomberg Commodity Index. And once again, as you saw in 2022, there was a high correlation between CPI and BCOM. That's broken down now for a whole bunch of different reasons, which we can get into. But this is one of the things where today's CPI number is really more backward looking, and there's more pain for the consumer coming in here from distillates and higher sticky inflation.
I think it just goes back to the CPI is not the only way to think about inflation, right?
Right.
It's a survey based, sort of its rent.
Well, so that's a great point.
Yeah.
So the CPI, right? This is versus BCOM. So
versus anything.
If someone's trying to manipulate, if say a government was trying to manipulate CPI lower for political reasons, you would think the first thing you would see would be CPI lower. But look at that chart. That chart's telling you, BCOM's telling you that red line there. That red line's telling you that something smelly is going on here. I'm not a tinfoil hat guy, but we know in 2022, the last time the Bloomberg Commodity Index, which is the red line, the last time it was up here, CPI was a lot higher. Yeah. But your point is too many people look at CPI?
It's just that CPI is not the only measure. Like
Yeah.
to me, I think everybody should own inflation in their portfolio. Like on a big side, like commodities. A lot of people look at commodities, but the commodities are expensive. Like you can look at BCom, but they're already priced high. The inflation expectations outside of CPI and with even the inflation protected bond markets are not priced well. They're just around 2% for break evens,
Yeah.
especially long dated break evens, and then inflation expectations outside of CPI are really cheap, and the price of implied vol is really low.
This is another indicator that points to something smelly. So, and we talked about this in our book. When you have sticky inflation in a multipolar world,
Mhm.
companies that own assets should start outperforming growth, right? Now, the Russell 1000 is companies in the value space. So that's the Russell 1000 value. And this is the Russell 1000 value versus growth. I find it very interesting that the stickier inflation has been over time, the more look at value starting to really outperform growth. It's the same thing we saw in 2022. So this is value outperforming growth. And this points to the DCF model, discounted cash flow, in a multipolar world with higher interest rates, higher inflation, sticky, the value stocks are going to outperform the growth stocks. And the Mag 7 has lost $2 trillion. $2 trillion since October has left the Mag 7. It's gone into a lot of industrials and value. Next one, Jose.
I would just, to your point about the Mag 7, and we were talking about 2022. In 2022, do you know what lost more than the NASDAQ? It was actually long dated nominal treasury bonds.
Right.
So long duration bonds were down more than the NASDAQ.
That's why this risk parity blew up, right?
Yeah.
So the 60-40 blew up in 22, and to this day, it's still, right? Are you in the camp of the 60-40 portfolios dead? I am, but
I think you need to augment core fixed income because it has, going back to like the 60-40
Right.
portfolio, it's all benchmarked to the ag. And I just don't think investors only want to be short
And-
OTC options.
and think about it. What we are living in a world for 30 years. If you benchmark for the ag, you sit back and that's all you had to do, right? But then all of a sudden, 2020 to 2026, we've got a 17 trillion fiscal and monetary response. It's a different world. It's a game-changing regime change. And that's why indexing to the ag doesn't work anymore, in my view. And that's why you need to look at other alternatives and other portfolio construction. Here you have, now this chart changed today, but as you can see, it's a lot like 22. In the bottom left there, you started to see the 2-year move out ahead of Fed funds. You see that bottom left? And then now all of a sudden, as Trump has kicked the hornet's nest in the Middle East, the 2-year, because the market, it's literally muscle memory. Everybody in the market's like, oh, we have an inflation shock because of the Straits of Hormuz, the war. We get rate hikes coming in, and you see the 2-year moving way ahead of Fed funds. To us, it's much more unsustainable now, this move, because of interest on the debt, which is 1.1 trillion, and the bottom 60% of consumers, once again, 4 to 5 years of absolute pain. You can see it in Home Depot, you can see it at McDonald's, you can see it in a lot of different stocks. Next one, Jose. And that's just, Fed funds versus the 10s. As you can see there, it's very interesting. So in all the other hiking cycles, like the last, and I love this chart, but all the other hiking cycles, 10s rallied a lot more. You can see that, so the blue line, all the other hiking cycles, now we're into this, we did this hiking cycle and 10s are essentially unchanged, right? Now we have cut, but we haven't seen the traditional reaction in the market. That's because of this commodity inflation, sticky inflation, and the fiscal and monetary overdose.
Yeah, and this spread between the two, if you look at the 2-year and the 10-year swap rate today, so not the Treasury curve, but the SOFR swap rate, it's 10 basis points.
Now, explain the difference. What's the SOFR swap rate?
So it's the Treasury market is the funded market. The swap market is the unfunded market.
And funded means people have to buy treasuries.
Yeah, like so if it's the Kingdom of Saudi Arabia issuing bonds in US dollars, or if it's AstraZeneca or Sony or Disney, the swap market is actually much larger than the Treasury market.
Right.
And the swap market is much flatter than the Treasury market. as well.
Why should people care about that?
Well, that's IVOL has access to the swap market, the SOFR curve. So, and it's only 10 bips. So it's cheaper to buy to benefit from, kind of that normalization, whether it's the 2-year. And I think both of your points are playing out to this story, because whether it's 2-year yields going lower or 10-year yields going higher, both of those steepen the curve. And a normal curve is about 100 basis points. Like 1% is kind of like normal. So having something that's so far below its average at 10 right now, especially when Japan is, close to 125, doesn't make a ton of sense.
Right. Next. Okay, and that's just a 10-year. It's the same kind of chart. Sticky. This is pricing in, obviously, the Straits of Hormuz being closed for 120 days is keeping 10s higher. That's pretty much it. Next one. And that's the same thing with the 30-year. Same thing with the 30-year. That's all long end being sticky, a multipolar world, some more sustained inflation. And once again, the DCF model, that goes back to industrials and value. If you have that multipolar world with sticky inflation and fiscal overdosing at the same time, and one to 2 trillion of data center spending in this year, last year, and then another 4 trillion supposedly coming down the pike, it all creates a higher long end, which the DCF model, discounted cash flow. When you analyze stocks, if the long end is more sticky, then over time the money's going to move from gross to value, because companies that control assets are going to be more valuable. Whereas if inflation is coming down and bond yields are coming down, then growth stocks are going to be more valuable. Next one. And this is just, this is indirects. Is Robert around? By the way, can we bring Rob in?
Yeah, I'm here.
Hey, bud. So, Rob, walk us through. This is important. The Washington pressure points and everything. You've been doing a hell of a job talking to all of our best contacts on the Hill. You're looking at. I think Rob's skill set's amazing, because he's looking at. He's really on the front lines of what's happening on issuance, on auctions, on SOFR futures and rate cuts. But he's also talking to everybody on the Hill. And Rob, we've got some legislation coming up. This government shutdown risk that you were talking about last week in the Washington pressure points is starting to leak out into the market.
Yes. Well, that's not really legislation. It's quite the opposite.
Right.
The Congress has to pass a new budget or approve a continuing resolution. And the Democrats right now, they never used to play the shutdown card. The Republicans was always very good at that. When you're in the minority, you have that power. You don't have that much power, but you can fight them over the debt ceiling. You can fight them over the budget, which means if these things get pushed out, there's no deal, then you go either through
Walk
a
us through the
shutdown.
timeline, Rob. So they're on a summer recess, and when do they need to finalize the budget?
Well, this needs to be done by the end of September. And, it's more likely than not, because they have not approved any appropriation bill that the
why
Democrats...
why do the Democrats think if the shutdown's going to help them in the midterms?
Because it's the onus on the Republicans.
Right.
Again, same as happened as last year. Approval ratings for the Republican Congress collapsed. Trump's approval rating that went down when they had this more than 1 month long shutdown. And the Democrats are going to try to play that card again, hoping that it would basically push the odds of the Senate flipping to the Democrats over the edge. It's now about 50-50. So there's that. Normally these shutdowns, there's non-essential workers, the implications for the market are somewhat unclear. When it occurs together with a debt ceiling, then it becomes a real market moving event. This time around, the spillover is primarily on politics and the midterms.
Yeah, and Rob, remind everyone what's fascinating about government shutdowns, right? And I love the convexity of this. The first week or two means almost nothing, because there's a lot of things the government can do for emergency measures. But once you get into that third, fourth week, that's where it starts impacting the yield curve and starts impacting risk. Right, Rob? Walk us through that. The last time around.
The impact on the economy is exponential.
Every day after the second week of the shutdown.
Yes, but I think at the end of the day, this is very much. I remember when this is the beauty of playing into Nancy's fund is that when you get gridlock in Washington D.C., when we look back for ever since World War II, when you get gridlock in Washington D.C., 10-year yields come down and the yield curve steepens. That's almost like clockwork. It never happened. It never happened the other way around because gridlock means the president doesn't get his budget through. There is no unified Congress. They're locking horns. They're going to nickel and dime Trump. That means lesser
Democrats
deficits.
will all of a sudden become fiscal conservatives, which I don't blame them. That that's what they're going to do. All they're going to be fiscal hawks, right? If they
Yeah.
win the midterm.
Yes, and so there's all these things in play, and then the economy, supply starts to slow down. It's still at a higher rate, but it's not necessarily what level it's at, but where it's going, and then your yield curve can steepen as well.
And so, if the Democrats, what trades are we seeing? And I can give you my view, but what trades are we seeing? What the government shutdown slash if the House and Senate both flip, then you go to massive gridlock, right?
Yes.
And then there'll be more restrictions on spending. And after all these years of overdosing on fiscal, that could really bring in some economic risk really fast without the fiscal juice.
Yeah, yeah. I mean, yeah, there could be
What are
some
the trades?
slowdown.
What are the trades for the midterms? That's what I'm trying to ask you.
Well, that's one of the big trades is that, right? One of the big trades is that you're going to have to play steepener once you go. Well, now the other thing is that, and this is something that we discussed with our Washington contest last week, and it actually goes back to the perversity of Washington politics. The two pieces of legislation that are still in Congress and waiting to get approved, that's the Clarity Act and the Bitcoin Act. And now no legislator will touch them until the midterms because they want to get their donation from the crypto bros as well as from the bank lobby. The bank lobby hates the Clarity Act because the Clarity Act would allow stablecoins issuers to pay some form of yield. They've whittled it down to paying some form of yield in the form of like air miles or these kind of rewards, but still, the Jamie Dimon and the banking lobby hate it. So they're paying their legislators a lot of money in donations. And then the crypto lobby wants the Clarity Act passed, and of course the Bitcoin Act. So they're paying the legislators and the donations as well. And these guys need their donations to run their election or re-election campaigns. So nothing is going to probably happen until the lame duck. So another trade would be that.
I'm sorry, what's the trade?
So another trade would be that. You'd be Bitcoin positive if they pass the Clarity Act.
Right.
And if they pass, and then subsequently they're going to have to pass the Bitcoin Act. And Trump can't afford to let the new Congress, which would be adverse to him because it would be democratically controlled Congress, he can't afford to let that legislation spill over into the new congressional year, which starts at the beginning of January. So those pieces of legislation will probably be passed in the lame duck session, which is from the beginning of November until the end of December.
Right. And so on the stablecoin side, and this is something I want to make sure you've heard this because we've been doing the dinners, we've been doing the private meetings. I met the Tether team, the founder. So the stablecoin thing is fascinating because it was like 100 billion five years ago. Now we're at 250 billion. If this passes, it could be 500 billion of stablecoins, and they're buying T-bills. So I think Besant, Warsh, they know the U.S. has 39 trillion in debt. They know China's buying less treasuries. So behind the scenes, they're forcing the banks to buy more treasuries. Number one, that's stealth QE. And they're also this is a big weapon of theirs. That's why they desperately want this because if they can get that stable coin up to the amount of capital in there up to 500 billion over the next couple of years, that's a whole bunch new buyers on the front end, right?
That'll steepen the curve.
That'll steepen the curve big time. And so I know based on, by the way, we have some people in the chat, former Treasury people. We've got some people, former Duquesne people. We've got a lot of people in the chat that are close to these guys. they know what they're up against. They're brilliant financiers, right? They're not some academic group. They know that they need the stable coins and they need the banks to buy more treasuries because they know we have less friends in the world. And they're afraid they don't want to go to yield curve control. That might eventually happen, but the first step is doing the percent bag of tricks, and that's what this is all about. The percent Warsh Druckenmiller bag of tricks. So this is, let's get through Nancy's slides. So this is a little bit about the background. Forbes, Barron's. You've been out there doing a great job, and you're partners with Crane, our friends. And next one, Jose. Okay, so
It's kind of an executive summary of IVOL.
Okay.
IVOL is long. 80% of the fund is treasuries or cash per prospectus. We use the inflation-protected treasuries TIPS, and then we try to solve the problems with TIPS by themselves by accessing long options on the yield curve. And it's a 2-10 SOFR curve. So
Right.
it's a very different strategy because it's accessing the rates market. There's a good slide, Jose, if you go to the next one about why do you care about rates. I think this one's really compelling because most people in their financial portfolio, they have their stocks, whether it's value or growth, they have treasury exposure, they have bonds with credit risk, but most people can't access the rates market because it is an OTC market.
Over the counter market.
Over the counter.
Why can't they access it?
Because it requires ISDA agreements.
Yeah.
It's very hard for regular, even
But
sophisticated.
what about some of these ETFs, not just TLT or but there are new ETFs on the front end of the curve, right?
Yeah, there are ETFs out there where you can trade options on ETFs, but there you're trading log normal volatility because equities and ETFs trade in log normal terms. What we access is actually the normal vol market, and our type of vol is much cheaper than swaption vol. It's not swaption vol, it's options on the curve itself because we buy these options on the 2s, 10s yield curve steepening. Our type of vol is around 3.5 basis points a day. So I know, we were looking at the move index. If you take the move index and you divide it by the square root of 252 to look at the daily vol, it's closer to almost 5. It's about 4.8. So our vol is just a lot cheaper to own. And we own these options on the steepener, which is, I think, a nice, safe way to have exposure to the curve because the curve did, it pancaked this year. It fell by almost, now it's 85% down year to date. It started at 49 and now it's 10.
Yeah.
But it can.
So you're rolling the options, you're rolling quarterly. So there's a cash burn to that, right?
It's active. So we're not rolling quarterly or it's not a stupid fund. It's actually actively managed.
Okay.
And our vol curve is downward sloping, which is really awesome because we actually roll up the vol curve. The longer dated vol is cheaper than the front dated vol, which is kind of opposite of equities. Typically, when you look at VIX curves and things like that, vol is upward sloping because the future is less known than the present, right? So it's normal to have an upward sloping curve. Our curve is actually backwardated in the vol space, so it rolls up the vol curve, which is why we put this as, for long-term investors, a great way to be long vol, kind of long-term. If you maybe go to the next one.
I'm going to move through these. So.
Yeah, and this is going back to kind of the 60-40 and sort of all the bond piece of the portfolio. Every institutional, whether it's a pension fund, 401k account, it's all benchmarked to the ag.
Right.
And the ag is 35% is short OTC options embedded in QSIPs. And that's, I feel like deja vu, didn't we learn anything, with the savings and loan crisis, the financial crisis?
It's the complacency of no inflation for 20 years.
Yeah.
That's just massive complacency.
And so I feel like the VIX is not what people really need to worry about. It's actually the embedded short interest rate options that's in vanilla bond portfolios. It's just inside QSIPs, and it has this nice G-rated term called prepayment risk. Prepayment risk is somebody else is long an option and you're short an option, and whenever you're short options, you're short vol. So,
Rob, do you have any questions? But Rob, I want you to think about questions because I think we'll start with questions from you. But next one, Jose.
Yeah, so this is kind of IVOL versus TIPS alone. IVOL does own TIPS. About 80% of the fund per prospectus is TIPS plus cash. We use a passive index for tax reasons because we do our treasury trading in kind. So we not had capital gains. It's kind of unusual. And then we use cash to reduce the duration. This is kind of the solution with tips by themselves. Because as you know, like people have been pretty frustrated. Tips create phantom income taxes if you own them, you know, your family office clients. People don't want to have the hassle. And then tips only reset with CPI. And then they're all long duration, which is kind of crazy, right? Like
Yeah.
when I started my career at Goldman in the late 90s, it was right when the US Treasury created the tips market.
So okay.
1997 was
So you're a family office. You've been using tips for years as part of like your structure. You've got your long corporates, long some treasuries, long some tips. What's the downside of the tips market is what?
it's got only CPI
Yeah.
is the only reset, and then tips are long duration.
Yeah.
So, like for instance, the first quarter of 21, IVOL was up, you know, I'm doing this off memory, 311 basis points the first quarter of 21. Whereas tips were down about 150 basis points during
Right.
that quarter. And that's because they lost money on their duration. So it's like if you want to own inflation, and people try to fix the the duration problem of tips by trading inflation swaps or break evens or, you know, CPI swaps, but it's all still going back to that core, you know, Bureau of Labor statistics telling you where the index is with their survey data. And even if they're perfect with their survey data, a third of this index is rent.
Right.
So we see what we're accessing with IVOL with the yield curve is like,
And then you have Warsh. Warsh is going to go to trim mean and change it all over again.
I know, like we don't.
They're changing the definition of inflation. You know?
Yeah, 2% he's confirmed, but we don't know what that base is going to be.
What are we saying here?
This is a neat one because this, I don't know if it's too small for your viewers, but this is looking at interest rate volatility and also the yield curve relative to tips long term. This is actually an interesting client. We had a client call from a pension fund consultant who was sort of like kind of big picture, like, why would you put long options with tips on the yield curve? Like, why would you do that? And this, I think, is a really great story to show, like, look, this solves the problem with tips by themselves. This is not a back test of the ETF because the ETF only listed in 2019. So it's 7 years old. This is looking at the kind of components, interest rate vol on one side and also the yield curve steepness on the other, compared to tips to show how they track and to show how, you know, in '08, the yield curve had massive steepening. This is kind of what a lot of, you know, macro hedge funds became known for, was because they had, you know, steepeners, especially options, because when you're buying vol at, you know, right now our vol is trading at about 3.4 basis points a day implied. You know, it's a lot of convexity you get for very little premium, essentially. Right. And this is a cool chart to look at, you know.
That's U.S. equity market sell-offs and the yield curve. Okay.
And so what it's showing is the yield curve going back to the 50s has historically steepened in these recessionary periods, and it all matters on expectations. And now we have these hikes priced in from the Fed. So if the Fed doesn't hike, that steepens the curve.
Right.
If the Fed hikes more, that would flatten the curve. But it's all based on expectations. And you can see the salmon bars are when the S&P sells off 20%. So the steepener is a really nice equity hedge. So it's a hedge for your bonds because it's inflation and has the exposure to 10-year yields going higher, but it's also a nice hedge for your equities.
Right. And that's why I wanted to bring you on today, because if you're skeptical of the Fed's ability to hike,
yeah,
because of the bottom 60% of consumers have 5 years, 4 years of absolute pain. You can see it in so many different consumer stocks. You can see it in the consumer discretionary versus staples. And at the same time, you've got all that pressure on the consumer, and you've got interest on the debt, this 1.1 trillion versus 250 billion. So I think there's something going on where people want to pretend that it's like the 90s again or the 80s. I mean, we just can't hike that aggressively without causing a major problem, because there's so much more leverage in the system. And so if they can't hike that aggressively and the market starts pricing in lots of hikes, if something happens, you can flip from hikes to cuts pretty fast.
Yeah. This is an interesting slide because it looks at the correlation, but maybe if we jump to the next one, because that's more like one more. this is kind of simplifying IVOL. Just very simply, it's got exposure to tips. So we want tip prices higher, tips going down, meaning real yields going higher, not great, how the fund works. But it's a pretty simple construction because it's always long only these types of options. And that normalization of the curve being 10 basis points right now with the 2s 10 SOFR curve, it's really not normal to be so flat. And there's so many different catalysts, whether it's a front end moving, going back to your slides about the 2-year, 10-year, whether it's a 2-year yields going down because the Fed doesn't hike as much as what's priced in, or whether it's a 10-year moving higher because the rest of the world is going to demand, more term premium.
Well, that's the other thing we haven't even talked about.
Yeah.
The UK yields,
Yeah.
French yields, China's issuing more paper. Mag 7 is issuing like 500, 600 billion between this year and next year.
Yeah.
All these new bond issuers that were never there before.
Yeah.
And they're all competing with US treasuries. And at the same time, China's buying less.
Yeah.
So there's a lot of moving parts here. And that's why it's so important to talk about this and analyze it from a different way. I will disagree with Rob. Rob, I want you to have any questions with Rob. I want you to start off the questions. Rob's point is and I want you to really think about what Rob's saying. He's saying the same thing Lacey Hunt and Rosenberg have been saying. And Rob is not in their camp because they've been really bond bullish for like 2-3 years now. They've been real bond bulls since 21, 22, 23. Because as recession risk rose in 2022, they thought the yield curve was going to steepen a lot, and they thought there'd be lots of cuts. And I think the one thing that's totally different this time is that 17 trillion of fiscal and monetary since COVID.
Yeah.
And we've never had it, plus the data center spending, right? So there's a lot more, and plus China's issuing, and the plus, Europe and the UK are having financial issues and they have to issue. So we are in a whole new regime.
Yeah.
I do believe that if you go toward a recession, there will be muscle memory and the curve will flatten a lot. But I think the long end is going to be much more sticky up here. But the question is how much, if they cut, dollar weakens and that reaccelerates inflation again.
Yeah.
So that's going to be the funny part. And that's where the commodity trade and the hard asset trade is really going to take over. But let's try to get some questions. Open up the questions. We'll go to the next slide.
I think this one's kind of interesting. Like IVOL's definitely had a tough year this year because the yield curve went from 49 to 10 so far in 26. But I think this kind of shows other periods.
And 49 to 10, you mean in terms of 2s 10s?
The 2s 10 so far, yeah.
Went from 49
to 10 today.
Yeah.
And that's after it steepened today with the soft CPI print.
Yeah.
So it's still, at one point it was down 95% year to date. And so using options, I think, is a lot safer way of accessing it because we have linear exposure it's compared to linear exposure. Like if you just have the exposure where you're using delta 1, you can lose a lot of money to have it go down 95%. So I think it shows the power of using long options here. Funds down, but it's not down 95% like the delta 1 is.
Right.
And this also shows periods of like when it was non-correlated to other things, whether it's mortgages or Silicon Valley Bank was, I think, a really great period for us. It was a hot second because then the BTSP came in, which was basically backdoor QE to.
But that's an example. Like the moment anything comes in, curve flattens because that muscle memory, like immediately the market thinks, oh, the Fed's going to cut 150 basis points, 200 basis points, and to get us out of this mess, which that's what they've done for 30 years.
Yeah, no, so it's a very interesting time though, because it's sort of like you don't know which end's going to move, but owning vol, especially in rates, I think is something that is important for people to have.
Are there any questions so far? Is Rob there? Rob, are you there?
Hi.
Yeah, anything that stands out that we missed, or a question for Nancy?
Well, I think one interesting phenomena is the inflation swaps, right? They're extremely low, right? The 1-year inflation swap dropped to the lowest level since 2024 now, today. And, normally tracks oil pretty decently, but that has broken down completely. And, further out in the curve, inflation swaps also point to, very low inflation. So that's helpful, right? If you compare that to
Now,
your
but Rob,
fund.
what's that telling you on a macro perspective? Isn't that telling you that the bond market, at least on inflation swaps, are worried about some type of credit event, or like why would inflation be low with 1.9 trillion of fiscal and $2 trillion of data center spending?
Yeah, well, that 1.9 trillion is not growing, right? It's stuck at 1.9 trillion now for 3 years. So it's 1.9 trillion, mostly dead money because it goes to entitlements, it's sunk cost spending,
Yeah.
right? It doesn't have, it finds no way to growth. So there's that.
Hold on, but that goes back to our original point. Yeah. So if we go to the midterm, maybe this is what it's saying. If we go to the midterms in this fiscal gridlock, that 1.9 trillion goes to 1.5. That a $400 billion hit would hurt inflation. Is that what you're kind of saying, Rob?
Well, I don't know. I mean, maybe it's the AI effect. But it could be a base effect, right? If you in a year from now, the high inflation prints of the last few months are going to be very low. I don't know. Some people might say you're going to have negative inflation because of the base effect year on year. There's also the AI effect, right? We don't really know. Like IBM this morning came out with a profit warning. I can't remember the last time the IBM came out with a profit warning, but and they say that a lot of dollars are going from software and consulting to AI now, and
Yeah.
that
But
is
Rob, isn't
that.
the AI disinflation trade, isn't that like 2-3 years away? If you're building all these data centers that's why Caterpillar stock is trading the highest percentage above the 200-day moving average ever by almost 100% more. But isn't AI a lot more inflationary in the early stages with the build out?
We don't really know, right? What are these cost savings for companies?
I'm trying to get him in the corner. I'm trying to get you in the corner, Rob.
Well, I think what Rob's
No,
saying,
we
if I can paraphrase, is
I love him.
inflation expectations are priced pretty cheap. And we don't know kind of whether it's going to be higher or lower from here. But I think given the fiscal situation, given we have expectations of hikes, everyone's expecting, the Warsh Fed to be just like the Powell Fed. And markets are often wrong, right? Most people didn't think Powell was going to hike as much as he did. He hiked more than Volcker, right? He did 525 basis points of hikes in 12 months. Nobody was expecting that until it happened. So I think to your point about muscle memory is that the Fed's going to be tough
Right.
on inflation.
Absolutely.
Therefore, inflation is priced cheap. And that's, I think, the thing that you and I are always talking about, and we're so simpatico with your book, is like, to me, inflation is just something it's not a trade. Like, it's something like we live in a real world, right? It's something, whether you're a pension fund, whether you're a family office, whether you're an endowment, I think everybody needs to have some allocation to inflation assets in their portfolio, and they don't. And you can see it in the pricing because it creates tracking risks too. Like the UK, they have a mandate for their pension funds to buy linkers.
Yeah.
Here, it actually creates tracking risks because there's no inflation in the ag. So
Right.
it's like kind of opposite, where the US inflation markets are so for sale, even though probably if you look globally, they should be some of the most expensive.
Right. Anything else, Rob, that stood out to you or that we missed, or questions?
No, I mean, I think it's a very good story. I like it a lot. Yeah, one of the things that we also pointed out in the Washington Pressure Point is one of the ways that the federal government has suppressed volatility in the Treasury market is to essentially for bank dealers to buy more paper, right? So if you look at the holdings of treasuries of banks since 2024, it has ramped up significantly, which goes hand in hand with the decline in rate market volatility.
Yeah,
Right.
it's a really good point, Rob, because rate vol has fallen almost 50% since Silicon Valley Bank, which was only in 2023. It's like nothing's changed, right? There's no reason that rate vol is so much lower, but it's just been, just constantly pounded, and it's so cheap right now, in my opinion, or at least the convexity to own directional options with it.
Yeah, these guys are very smart guys.
Yeah.
And, they have They have a lot of tricks up their sleeve, and and that's why a lot of people are afraid to bet against them. That's why people think that Trump has a magic wand where he can just suppress oil prices, and the midterms, and they have with the SPR. They unloaded the SPR at the fastest rate of change ever, really. But I just think in the next 3-4 months, the distillate thing is huge. Just look at diesel. Look at jet fuel. Look at gasoline. You look at data center spending and all that kind of matriculating into the second order, third order effects of near-term inflation. So I'm in the camp where you get the inflation bounce and with high conviction. But then I do feel the second part of that trade is that inflation bounce hurts the credit markets because the credit markets are wounded anyway because of private credit. There's a lot of off-balance sheet lending and data center stuff. The return on invested capital there is really up in the air. Zuckerberg, I think, controls 31 data centers. So it's really a testosterone fight. And it's amazing because Zuck's like, he's a real madman. I mean, this is a guy that lost $500 billion on the metaverse, but he has this cash cow from advertising coming out of Instagram. It's a delicious cash cow. So he's willing to bet it against all the other guys. And even when the market, so we have a client of ours that's really close with the family offices of Zuckerberg and a bunch of these guys and Larry Ellison. We've got a whole bunch of clients that are friendly with these guys. And I'll tell you one thing, in the last month, the market's been last 2 months, punishing Meta and Microsoft in a vicious way. And it's almost like the beast inside the market's been saying, okay, you guys want to load up on CapEx? You guys want to keep this rate of change on the upside to like really all in? Your stock's going to pay the price. Mm-hmm. And I think that board members, people that own a lot of these Mag 7 stocks have really started to push back and started to ask, like, is this the right way to go? And Zuck stood up to them in the recent days. Rob, what did Zuckerberg essentially do? First of all, he has that compute power, right? So now he's trying to say he's got this compute that he's bought all this data centers. He's going to actually offer that for sale, right? And then that's going to potentially give him a new cash flow revenue because he's got all this compute power on the side. But Rob, is there anything on this? You got Meta and Microsoft reporting in 2 weeks, and from what happened last week, is there anything that's on your mind in terms of what Zuckerberg just did?
Well, they're all trying to get their stock price up. And I think a lot of it is correlated with memory, right? Every time memory stocks go up, some of these hyperscalers go down because the street is worried they have to spend more on memory. Memory is something like 30 to 35% now of CapEx budgets for building a data center. And that's not helpful to anybody except for the memory maker. So we've seen a massive amount of capital flowing into all kinds of semiconductor stocks because it's just memory, it's GPUs, it's CPUs, which is AMD, which is Intel. And
Rob, think about that. Think about Trump's like doing everything he can to get oil prices down, but that memory inflation going into Apple and all computer products, right? So isn't there like this inflation force that's coming at us from memory that's in the consumer side?
Well, you don't have to buy an iPhone, right? Nobody's forcing you to buy an iPhone, right? You can
memory's
offset
in a lot of things, but memory's in computers.
They force you to buy the data, right, with your iCloud.
Yeah.
Right. Yes, but look, so on the data center side, I think that Meta had to convince the market that they have a competitive large language model. They've been working on it for a very long time. They hired this guy and Andrew Wang and his whole team. And last week they came out with Muse Spark, which is a very, very good frontier large language model, which is apparently competitive with Anthropic and OpenAI. But then they also said, yeah, well, with some of our data center capacity, we're gonna rent it out if we see the economics. Well, the economics are there, but they don't have data center capacity. No one has data center capacity, right? Anthropic is short data center capacity. Meta has.
And what do you mean by that? Meta doesn't have it now because they will have it over time, but they have to build data centers, right?
Yeah, but here's the thing: token consumption is going up 30x, right? So last year, token consumption, as measured by open data, was a 2 trillion, tokens per week. Right now, it's at 60 trillion, and that's only 1% of total token consumption. So it's going up at 30x. And nobody has the data center capacity to meet that demand as it continues to grow. So they're feverishly building these data centers, but a lot of states that say, well, we don't want this, or there's all kinds of regulatory constraints. So they have to constantly juggle that with the demand for tokens, which is rising exponentially, logarithmically. So that's why Musk wants to put these data centers in space, because you have ample energy, which is free, you have cooling, which is abundant, and you have no regulators or politicians who are hemming and hawing.
Right. Well, yeah, that's the other thing about Mag 7 is if Elon is right, and that company is really gonna basically the Mag 7 is gonna spend 4 trillion, 5 trillion over the next 5-6 years. And a lot of that's going to SpaceX. And so eventually, as we rotate out of US data centers into the space, it's you get essentially Elon's just raiding Mag 7's free cash flow after they just had it all rated the last couple of years. It's going to be
took out huge debt to build these data.
right.
Just going back to your credit cycle.
$1 trillion
Yeah,
balance.
right now it's everybody's in this race to build, and technology is so deflationary, right? With innovation, it's
Yeah,
sort
it's
of
gonna be
kind of crazy to
it's
do
gonna be fascinating.
bricks and mortar with debt to build something that's a technology.
Yeah, you've got this inflationary impulse, I think, near term, and then potentially massive deflationary forces on the backside. But I think it was a good meeting.
Yeah,
good to see you.
see you.
Really been a long time. We've got the dinner Wednesday night. The doctor's coming in. We've got Joe Livornia. We're gonna have some incredible tales from the trails, and that's what we do at the Bear Traps Report. We sit down in over 20 countries the last year and a half, and we sit down with the best hedge funds, mutual funds, and pension fund managers from Toronto to London, New York. This week we've got the dinner, and then on the 23rd we've got the cocktails for a little bit more broad audience. But with the dinners, you got to keep it tight.
Yeah,
because the big guys don't want it. They want a private room with no more than 15 chairs. But thank you, everyone. Larry McDonald, Robert Ben Bettberg, but ladies first, Nancy Davis, and to IVOL Quadratic. Thank you, guys.
thank you.